This lesson is part of the price action series, and we're going to look now at a very common occurrence in markets, which is a false breakout, also known as the fake out. You maybe hear of it known as a fake pump, a fake dump, or just a fake move, whatever. Basically, it's a move that goes in one direction, and instead of continuing trend, it reverses back in the other direction, normally trapping traders or stopping traders out. Very simple. You can see the image on the screen where there is one shown, price is in a range, it's in a tight range, it attempts to break out above the range, fails to do so, falls back inside range, and continues to go sideways in consolidation before eventually a real move comes. So that's a fake out. You know what a fake out is now. But let's talk about why do they occur. That's what we really need to know. We need to understand the mechanics behind false breakouts. So they occur for many reasons, but you can broadly group them into one of these 5 categories. First, engineering liquidity. False breakouts can occur due to market manipulation by smart money who are trying to trigger the stop loss orders or trap breakout traders with a false sense of market momentum. So they push the price above a key high or below a key low to stop people out and to induce breakout traders. That's the first and the main reason for false breakouts. Second is simply a lack of interest or volume. So if there's a lack of volume in the market on a breakout, the market can be more susceptible to that being a false one. If there's not enough trading activity to sustain that breakout and build momentum, the price will just fall back below the breakout level. So lack of interest is another way. So one, you can push it up and take people out by triggering their stop losses or engineering that liquidity, or the market can genuinely just try to break out, but there's not enough people willing to keep moving it and it just falls back inside. Doesn't have to be any manipulation. Most of the time, the market just moves based on, basic buying and selling. It doesn't always have to be manipulation. 3, another reason would be technical indicators. It's quite common in crypto. So in very technical markets of crypto, which is one, because there's not really very solid real world fundamentals to base the value of coins on. So a lot of it's relying on technicals, moving averages, trend lines, patterns, things like that. And they can give many false signals. The most common of which I guess would be like a trend line break, where you have a trend line on the chart, price breaks above it and breaks above a key high in the meantime, but it's a trap, it reverses and goes the opposite way. Traders who rely solely on technical analysis will fail over time. There are far too many false moves occurring purely due to TA for you to be a profitable trader only using TA. That's why everything within this course teaches you how to be a well-rounded trader. 4th way would be news events. News events can trigger false breakouts, and they're often used in combination with the first point, engineering liquidity, by insiders and smart money. So people who know about the news first, in the days or weeks before, will move price up to a key level. Let's imagine it's on an uptrend. They'll move it up to a key resistance. They'll set some highs. Then when the news releases, the bullish buying or seemingly bullish buying between the insiders and the retail and the late entrants pushes price above that high. And instead of continuing higher, the smart money who knew about this news in advance are already waiting to sell, to take profit, and use the dumb money as exit liquidity. And then you see price reverse. Very, very common, especially in crypto. And last, and in my opinion, most importantly, is simply time. And we're going to look at that through the lens of Wyckoff phases. So by now, you should be noticing that many of these reasons sound very familiar to you. In the past lessons that we've gone through, I've talked about this, in particular with the lesson on market manipulation and liquidity engineering, and also in the lessons about Wyckoff theory. You know from the Wyckoff schematics that we've looked through and broken down that false breakouts are a common occurrence, and in fact are necessary for many Wyckoff structures to play out. You have your upthrusts in distribution, you have your springs or sweeps in the accumulation phase. So by looking at it through the Wyckoff lens, we can see something cool. So remember the principle of cause and effect from Wyckoff and take that as a key reason for false breaks. Most of the time, the breakout simply happens too soon, meaning that the market hasn't spent enough time in reaccumulation or redistribution in order to start the next trend. That is where understanding the phases of Wyckoff theory are particularly helpful. Phase A to C are the most common areas to see false breakouts, and so you should look for them to occur in this area. False breaks are also most likely to occur on the first and second attempt to break out of a range, and after that it becomes more likely that we're in phase D or actually ready to break out to a new trend. So let's break that down even further. Looking on the schematic here on the screen, you can see Bitcoin in a distribution on the daily chart. And on this distribution, we see the phase is beginning. You have your buying climax and the first significant sell-off into the automatic reaction and the secondary test. What matters then is when we push up to this high, given that you've studied Wyckoff and you understand how accumulation and distribution work and that they take time and the law of cause and effect applies, which means for every effect that you see, there must be a proportionate cause. You cannot just continue to move strongly in one direction all the time. The market needs to stop and rebuild energy in order to keep moving. If price rapidly increases, like Bitcoin had in this example, where it had gone from 20K to 58K in a very short space of time, it's not reasonable to expect that it can just keep going to 60, 70, 80 without any stop off, because the person just a few weeks before was able to buy Bitcoin for 20K. So why are they going to turn around and suddenly buy it for 60K? It's too soon. So the price would need to go sideways, up and down for an extended period, to either build a base of reaccumulation, or in this instance, it ended up being distribution. But regardless, the principles are the same. Price needs to go sideways. It needs to recollect its energy before it can explode into another trend. That is to anchor price for people. If you imagine Bitcoin at 20K and then it blasts off to almost 60. But then a lot of people are saying, well, I don't really trust this. It's almost 60K. It was just 20K a few weeks ago. I don't want to buy here. So what happens? It drops down, but then it finds support at 45. Bounces up to 60, bounces down to 45 to 48, bounces up to 65, bounces down to 45, 48, 50. The more times it does that, it anchors in the minds of traders and investors, oh, there is support here, there is resistance here. So they begin to believe that, okay, 48 to 65K seems to be the range of fair value for Bitcoin. So instantly they forget all about the 20K that was, the price just 3 or 4 weeks ago. And now they think, no, this is the new price of Bitcoin. That's essentially what's happening in this cause and effect phase, the distribution or accumulation. And so phase A is where the buying climax is set. So occasionally you'll have a false breakout in phase A, but more likely you'll have it in phase B and phase C. And this occurs on all time frames. The first attempt to push higher, as soon as that finds resistance and rejects back inside, that's when you're looking for short trades. That's when you're looking to say, this is a confirmed false breakout, because you know that it essentially just moved too fast. And even though you haven't seen all of this occur yet, we're just imagining in real time here, you still understand the principle that we are most likely to be in phase A or phase B. It's not about knowing for certain, but if you study the lessons and you understand the nature of cause and effect, you can say, we have not consolidated for long enough, therefore this breakout is more likely to be false. That doesn't mean that you short above the high. That means that when it comes back below the high, you short with high confidence. Okay? Then we move ahead. So now we've had one false breakout, also known as an upthrust. Then we move ahead and we get another false breakout, upthrust, and we reject back inside. Now, again, as a smart trader who studied Wyckoff theory and understands cause and effect, you look at this one and say, well, this not only looks like a upthrust after distribution, the UTAD, but also I know my principle of false breakouts applies, because we're likely, if this is a UTAD, we're likely to be in phase C. And phase C is the most common of all for having false breakouts. So you can short with high confidence, knowing that you're probably right on it being a false breakout, but also if you are right that it's phase C, what comes after phase C? Phase D. And what is phase D? It's a show of weakness. So you know that if you catch phase C, you're going to get the biggest move, because there has to be a show of weakness after, because it's likely distribution and likely that this structure won't hold. And then we see that. So that is how you use the principle of time. When I say it just seems like we simply haven't consolidated for long enough, that's what I mean. If it's too early to break out, either to the upside or the downside, we likely just reject back into range and we continue to range until there is such momentum in the market that we move into the next trend. So finally, and time still applies in this instance, but let's look at another way to measure and execute false breakouts, which is through volume. I mentioned point 2 back at the beginning, which was lack of interest or volume as being a key level, a key metric for measuring false breakouts. What does that mean? This one is particularly useful. It's useful on all time frames, but this is particularly useful for non-Wyckoff short time frame analysis. You're not always going to see a Wyckoff distribution or accumulation. It's not always going to look like that. Sometimes you have fast patterns, which we've talked about in the past. Your double tops, your failure to return, your sweeps, and your climax, your exhaustion, tops and bottoms. You can add the false breakout principle with a lack of interest in volume as a good confluence tool for spotting high probability tops and bottoms. So let's break it down. Look at volume, have your moving average and volume so you know what's above average, what's below average, and then look at how price reacts at areas where it should have high volume. You might remember this from a previous lesson, another Wyckoff lesson, which is harmony and divergence. So what happens here? We have a strong uptrend with multiple green candles, high volume, and then we move up again into another strong, seemingly strong breakout, but this time much lower volume. We had some above average volume on the break, but then the very next candle put in a bearish candlestick for one. You can see that from the candlestick patterns lesson if you want to check that out. And also lower volume, even lower volume again, and then most importantly in this particular structure, the highest volume of all 4 bars above the high, so the high is in the black line, all 4 bars above the highest volume of all is the bearish one that breaks back into range. Super strong, super strong signal, because that means there was nobody willing really to buy heavily above the high, and whenever the time came to go back inside, everyone was rushing to get out and sell. We then even get a nice perfect retest of it, even twice, leads into a downtrend, and you can catch the sell-off based on that. That is lack of interest in volume. So when you spot the breakout, remember, you're not guessing. You're watching these occur. These are 1 hour candlesticks, by the way. So you've loads of time. You're watching these 3 candles occur. You're looking at volume. You're saying, okay, if this continues to trend, then great. But if I do see a rejection back inside and volume supports it, which it does here, then I'm looking for shorts. And then you short the retest. You short wherever. You use your other system, your other methods to find a good entry. And then you catch your trade down and exit it again where your rules tell you to exit. So false breakouts, that's it covered. The 5 reasons behind them, how you can spot them, how you can look at them through the lens of Wyckoff in terms of phases and time, and also how you can look at them through volume analysis just simply on a chart.